welcome to another episode of Economy and Markets TV. I'm Dave Okenquist, Senior Research Analyst here at Dent. It is Friday, which means it's time for Rodney Johnson to join me to go through our regular weekly dive into the news of the week. Rodney, welcome aboard.
Thanks, Dave. Good to be here again.
Of course, Rodney is the co-founder and senior editor at Dent Research. Rodney, are you feeling good about this week's show? Last week we had a little bit of a technical snafu there. It kind of cut out some of the audio, so hopefully everything will go well. I was mocking Friday the 13th last week, but now maybe I'm a believer now.
Exactly. So we'll hope this week will go better.
Okay, yeah. So with that, let's move on. Just so everybody knows, we try to keep things moving a bit here. So I have try to set the 2-minute time limit for every topic. I have a bell, and I'm not afraid to use it. And it sounds like that. With that, let's move on to our first topic. At the top here, we've got retail sales. We're up 0.6% in March. This follows a 3-month decline in retail sales. So we get a little bit of a pop that kind of broke expectations. Why, Rodney? How do we attribute this surge in retail sales?
It was cars. You know, we had a pretty good month for auto sales. And we saw that reflected in auto sales that were reported earlier in the month. Mm-hmm. And of course, they flow through as retail sales. You strip out autos and some other things were good. A couple of things were falling away. Certainly department stores still having an issue. The bigger question around retail sales is why they're trending lower. And even this, resurgence being so focused in autos is not widespread. And because people had expected after the tax reform, Americans getting bigger paychecks, which we've discussed here many times, would turn around and spend the money. Now, that wasn't our forecast. It's not what we've looked at. We thought that there would be a pickup, kind of brief, and then it would fall away. The fact that it happened to center in cars took me a little bit by surprise, as we've talked about, because I think cars are really trending lower in terms of sales. But still, we're not seeing a huge run to the store. We're not seeing people go out and spend all their nickels. And so that's got some people concerned, because if they're not spending at retail sales, then we don't get that bump in personal consumption, which is the biggest contributor to GDP. Without it, you don't have strong GDP growth, and that kind of puts everything at risk for the rest of the year, which frankly is what's been our forecast for some time.
Yeah, so I see autos were up 2%. So just so everybody knows, auto sales make up about 20% of all retail sales. So if that's it's the biggest one in the category. So as that goes, sort of everything else does. But once autos, if they do roll over, I think to your point, then there's a lot of weakness there. Exactly. You mentioned GDP. The latest update to GDP now is 2%. So we'll find out next week the final number. So we're just kind of sitting there at 2%. So we'll see.
Well, and remember, they started at over 5% or 4.5% up to 5%, and now it's been pulled back. And so the administration has been saying, hey, 3 to 4. And, I like a lot of the deregulation from the administration, but we do not see 3% GDP growth. And frankly, as you said, next week we'll get the first estimate of first quarter GDP. We expect it to be right around that same moribund level of 2%, which is not going to excite anyone.
Yeah, absolutely not. So with this idea of sort of sluggish growth, that leads us to our next topic. The chief economist of Fannie Mae, Doug Duncan, says there's going to be a recession in 2019.
Yep.
That's nothing new coming from, hearing it from us, but we got somebody in a prominent position in the government, someone who knows what's going on, who's saying he's looking out just a little bit ahead, saying danger here. So that certainly is something to pay attention to, right, Rodney, when someone comes out like that?
It is, and I think you're going to hear more about it. He's looking at a couple of things. He's looking, of course, at housing. He is the chief economist of Fannie Mae, and Fannie Mae is not a direct government entity. It is private. It does have stock, but they are under conservatorship of the Federal Housing Finance Authority, the FHFA. And so he does hold a prominent position. He's looking at the length of this expansion, which is the second longest on record and soon to be the longest on record, and eventually those things end. Now, being a long expansion doesn't mean it has to end, but it does add to the weight of guess what, eventually it will. And so he's looking at housing prices, he's looking at affordability, and frankly, it's just not there. And so in his view, we're kind of set up for a rollover sometime late this year. I think 2019 is when he was looking at, and we tend to agree. And so I think you're going to hear more about this as we go through this year and get towards the end of 2018 without a lot of GDP growth, and people start scratching their head and saying, maybe things aren't as rosy as we all thought they might be.
Well, it sounds like he's coming along to your position.
Yep.
Sound like
just get everybody to come to our side of the table.
Now, was there a concern about rising rates? I wasn't sure if that was in the details. Is that one of the things to Fed action?
And you know, I don't want to beat on rising rates too much because I've certainly talked about it. You're hearing more about it from other sources now. We've been talking about it for months, and now people are saying, hey, earnings are great, but guess what? We do have this rising rate scenario, which is what we've been beating the drum about for some time. And so Duncan also mentioned that as one of the things that will kill the expansion.
Yeah, absolutely. All right, well, that's all I had on that topic. We are moving right along here, which is great. Our next one is an update on the great 2018 trade war, or so-called.
Right.
Latest thing that came out, latest big news, there was an announcement from China saying that they were going to lower their restrictions on basically what they have is if you're a foreign company comes into China, it has to be 50% China-owned. Is that correct, Rodney?
Well, if you want to produce in China, and so you can import cars to China, but it's a really hefty tariff of 25%. And so if you want to avoid the tariff, then what you do is you set up local production. Well, to do that, you're required to have a 50% partner of a Chinese firm, a local firm, which tends to be a state-owned entity, which of course then steals all of your trade secrets and everything else. And so it's a bad deal, but it gives you access to, you know, the second largest populous country on the planet that has a very fat, quickly rising middle class. And so people made the deal. I mean, they weren't forced to, but, you know, they still did it. And so the Chinese president, Xi, said recently that they're going to relax that. They're going to have it totally relaxed or eliminated by 2022. Mm-hmm. And the part on electric cars is going to go away this year. It sounds like great news. It's not as much of an effect as you might think. For companies that are already there, they already have partners. And so what are they going to say? Gee, we're not going to do this anymore. We're going to set up our own dealerships and have our own stuff. It's really going to take a lot for them to unwind that. I think they will, but it will take years for that to happen. Tesla's kind of the big one because Tesla refused to do it. They do sell cars over there, but it's with the tariff. And so this will allow them to set up in country and actually produce and potentially sell more cars. How quickly that'll happen, I don't know, because there are a lot of electric cars in China that cost a lot less than a Tesla, but it's still a status symbol, so it's possible.
Well, it's funny you mentioned Tesla because I think I mentioned on this program a couple of weeks ago, Elon Musk had tweeted at Donald Trump really about this exact same issue. So you're suggesting it was really about Elon Musk wanting to get access to the Chinese market in that way.
And that's exactly what it is. And it's getting access on the same footing, right, that they have access to our market. And so I have nothing, you know, against that. As a matter of fact, I'm very much for that. Yeah. The question is, how much of a difference will it make, particularly since Elon Musk can't even produce the cars he said he's going to produce right now, and then he's going to go set up a new factory and do more. That's kind of a question mark.
Perfect. Oh, thank you very much. So I was going to ask you if this is a win for the U.S., but it doesn't seem like it's really much of a win at all, really.
I think it's a win. And wins come, you know, in several forms. One of them is you get an actual concession from a trade partner. This is a concession. Does it have a big effect? Maybe, maybe not, but it's still a concession. And what did it cost us? That's a good question. The other is psychological. I mean, President Trump is playing hardball in a way that previous presidents, or certainly recent presidents, have not, and it seems to be working. And so, you know, call it what you want. He's out there playing hardball. Other people are saying, okay, we'll come to you a little bit on this. Seems to be a win.
Thank you, Rodney. So our last topic today is April 20th, or 420, as people who enjoy marijuana like to say. It's sort of a celebration day that they like to partake in the drug. So, you know, with that, we actually have a bit of serious news regarding marijuana. Rodney, you had a little bit of a tidbit.
I do. And to give a little background for those who aren't familiar, 420 is a holiday or a day of celebration for those who do smoke pot or enjoy marijuana. And that's why you'll often see 420 signs stolen. For anybody that's seen a mile marker 420, I live in Texas, and we have those because things are more than 420 miles apart. They tend to get stolen quite a bit. And that's what it has to do with. So you'll see that. But as you said, on a serious note, GW International, which is a pharmaceutical firm, announced that it has recommended approval. The FDA has recommended approval for its drug that treats childhood epileptic diseases. And it is a marijuana-based drug that has a high CBD content, which is the one that blocks the pain receptor, versus the high THC content, which is the one that has the psychotropic effect. And so it doesn't make you high in the normal sense, but it does give you some relief. And so it's been shown to be very effective for treating epileptic seizures. And so this is really good news. But it's one in the column of, hey, we're approving this as a drug on one side, but it's still a Schedule I drug per the DEA.
Right.
That's a problem because Schedule I specifically says has no known medical benefit. Now, if the FDA says yes and the DEA says no,
right,
who you're going to believe? So I think I'm going with the FDA on this one.
Yeah, so we're starting to see things change, the wheels change regarding this, and even Attorney General Jeff Sessions had maybe suggested that there might be some prosecution on states that have voted their own laws, but that was apparently put down by the president. So it looks like this is going to continue, and if people can get the treatment that they need, that's great. I'm all for that.
Me too.
So with that, that's all we have for this week. Next week, just to let you know what we have coming up, we've got new and existing home sales, the U.S. Home Price Index, durable goods, and then the big one on Friday, we're going to get GDP. As I mentioned earlier, the Atlanta Fed GDP now has growth at 2%, so we'll see if we're just going to keep muddling along right around 2%, or if there's going to be a surprise there. That's all the time we have for this week. I want to thank everybody for joining us. Rodney, thank you for coming on. As always, you can find us at dentresearch.com and on social media. And if you don't subscribe to the written version of Economy and Markets TV, please do so. Rodney, thank you very much. We'll see you next week.
Thank you, Dave.